If you have federal student loans and you want to pay them off as quickly and efficiently as possible, boy do I have a treat for you today. In today's video, I'm showing you a 4-step strategy for optimizing your student loan repayment and sharing what no one has told you about how to pay off your student loans fast. Spoiler alert, the path I'm showing you today has nothing to do with consolidation or refinancing, and this is definitely not your cookie cutter video, so make sure you stay tuned. Hey wealth builders, and welcome back to another episode. If you're new around here, my name is Akiva, and on this channel we talk about all things money for young adults just like me. So if you're into that kind of thing, I hope you come join the squad by hitting that subscribe button and turning on the post notification bell so that you never miss when we post new videos. So those of you who've been a part of the squad for a while know that I have currently over $80,000 worth of federal student loans. Right now I am in rapid debt pay down mode, and my current focus is paying down my car note, which I plan to have paid off by the end of the year. And after that, it'll be go time for my student loans. So I asked myself, what is really the best way to maximize my student loan payments? And this is the 4-step method that I've devised. Step 1 is to set up AutoDebit with your student loan servicer. Setting up AutoDebit from your bank account not only ensures that you never miss a payment and that prevents your account from becoming delinquent and screwing with your credit, it also reduces the interest rate on your student loans by 25 basis points, or 1/4%. So if one of your student loans carries an interest rate of 6%, for example, by setting up AutoDebit, you reduce your interest rate to 5.75%, which can save you hundreds of dollars over the life of your repayment. Step 2 is to determine the best repayment method. Now, I'm sure that most of you by now have heard of the debt avalanche method as being the best way to pay off debt. If you're unfamiliar with what the debt avalanche is, it's the method of paying off your debt in order of highest interest rate to lowest interest rate, regardless of the size of the debt. In the vast majority of cases, it is the fastest way to pay down debt and results in the least amount of interest paid over the life of your loans. I actually went and did the math to prove that theory using this awesome spreadsheet that I found online, and I'll make sure I link to it in the description box below so that you can check it out as well. This spreadsheet compares the debt avalanche method, the debt snowball method, which is paying in order of lowest balance to highest balance, and also compares against paying from the highest balance to the lowest balance debt. And this is all using your specific debt. So like I said, I will link to that spreadsheet in the description box below because I found it to be a really helpful, really powerful tool. In short, when I compared the bottom line amount of interest that I would pay under each of those plans, the debt avalanche, the debt snowball, and paying in order from highest to lowest balance, the debt avalanche method came out on top. The difference in the amount of interest paid under each of those plans, the debt avalanche, the debt snowball, and paying from highest balance debt to lowest balance debt, the spread wasn't that big for me actually, because coincidentally the interest rates on all of my debt pretty much are directly inversely correlated to the size of my debt. So chances are the gap is much bigger for those of you who have more varied loan balances and interest rates. Step 3 is to choose the right federal repayment plan, and this is key, so listen up. With federal student loans, many of us tend to forget that just because you have one monthly payment does not mean that you only have one loan. In fact, most of us will have 8 separate student loans carrying 4 different interest rates just from undergrad alone. The key to remember is that your one monthly student loan payment is really just the individual payments for each of the individual loans added together. So when you make your payment, your student loan servicer splits that amount between all of your loans. So in an ideal world, if you're using the debt avalanche method to pay off your debt, you would only want to make payments toward the loan that has the highest interest rate, which is the loan that you actually want to pay off first. But since you can't do that, the key is to get your student loan payment as low as possible. That way, the minimum amount you have to pay on each individual loan is minimized, and you can use any additional funds that you've budgeted to put towards paying off debt only toward the principal of that specific loan that you actually want to pay off first. And it's really important when making that additional payment above and beyond the minimum that you specify that you want that additional payment to go toward the principal balance of that particular loan. So how do you get your payment to be as low as possible? A good place to start would be the good old federal student loan repayment calculator. And I've mentioned that several times on the channel before, and it'll be linked once again in the description box below. So that's what I did. I went on, I linked my federal student loans, and then looked for the repayment plan that resulted in the lowest initial monthly payment. Now, I personally didn't choose any of the repayment plans that are income-based because I didn't want to be in a situation where my repayment was fluctuating wildly from year to year, based on income changes. And being an upwardly mobile college grad, I knew that most likely my income would just keep increasing from year to year, and so I didn't want my minimum payments to be increasing along with it. Here's the thing, many people recommend the standard 10-year repayment plan as the best plan for paying off your debt quickly. However, the issue is that this plan also results in the highest minimum monthly payment, and that defeats the purpose of what we're trying to do here. So for me, I chose the extended graduated repayment plan. And if you guys want another video going more in depth as to the different payment plans that exist and just explaining the differences between them, let us know in the comments below. On the extended graduated plan, my loans are amortized over 25 years. Payments on this plan start off really low and are designed to only cover interest in the first few years of the plan, and then it gradually, very slowly increases over time so that you're able to hit some of the principal as time goes on. So under this plan, I'm making the smallest amount of monthly payments possible while keeping my loans from growing and being able to focus on paying off the debt that I want to, which is my car note. Do I intend on having my student loans around for 25 years? Absolutely not. However, this plan gives me the most flexibility and control around paying off my debt. Another perk of choosing this plan is that because my payments are so low, it gives me a little bit of a buffer in case I fall on hard times, for example, so I don't have to turn to things like forbearance and deferment or potentially miss payments, which could have a catastrophic effect on my credit score. Now, in the same spreadsheet that I showed you guys a little earlier, I took things a step further and calculated the interest that I would pay over the life of my repayment under both the standard repayment plan and the graduated extended repayment plan. And I did this by messing with the required monthly payment over here in this column. And again, the ideal scenario came out to be exactly what I expected. I paid the least amount of interest by combining the debt avalanche method with the extended graduated repayment plan. Now, step 4 is an easy one. Make payments as soon as you have the cash. Student loan interest compounds on a daily basis, so the sooner you're able to make payments, the more you'll save in interest. So if your payment isn't due until the 8th of the month, but you have the money on the 1st, go ahead and make that payment and save yourself some money. Now, a quick note on consolidation and refinancing and why neither of those strategies were right for me. So when you consolidate your federal loans, all you're really doing is combining all of your loans into one massive loan. And the interest rate on that loan is just the weighted average of all of your existing interest rates to begin with. So you're not really saving anything. And you're removing the possibility of picking and choosing which loans you want to pay additional money to. Now let's talk about refinancing. At one point I considered refinancing my Parent Plus loans into my own name, and I've made a video on that experience that I'll link in the cards above. I ultimately did not go with that option, and I explain why in that video. So let's summarize. To truly optimize your student loan payments, you should first set up AutoDebit with your loan servicer, choose the right repayment method, which in my case was the debt avalanche method, combine that with choosing the right student loan payment plan that will result in the lowest minimum monthly payment, and then using additional capital to focus just on the loan that you want to pay off first. And then lastly, make sure that you make the payments as soon as you have the cash available. If you got value from today's video, go ahead and write the word value in the comment section below. If you have any questions on debt or student loans specifically, or if you have any other suggestions for future videos, also let us know in the comments below. Before you go, don't forget to come join the Wealth Builder Squad by hitting that subscribe button and turning on post notifications by hitting the bell. And to learn more about all things money for young adults, make sure you hit one of those videos that's coming up on your screen right now to keep watching. Thanks so much for spending this time with me, and I will see you in the next video.